Hi, everyone. In light of the market volatility over the last few days, I wanted to share a little bit of perspective. It's really easy when all the symbols are in the red and the news cycle's on to get swayed by all the negativity. The old adage is that bull markets are sort of a long escalator ride up, and then bear markets are a fast elevator ride down. Drawdowns can happen really quickly. We've seen that over the last couple of days, and they leave us all sort of feeling shocked and sort of trying to understand what's happening. All that is very normal and sort of very natural if you feel that way. But understanding what's happening, keeping a long term perspective, I think those are the things that are key to helping us navigate through market volatility and not make sort of rash decisions that we ultimately regret down the road. So let's start with what's been happening over the last few days, and we'll talk about what we think it means and what we need to do as investors, how we're positioning client portfolios, all those sorts of things. So what's happened over the last couple of days? In the first chart, you can see sort of we go back to July 15th. That was really the market top, and we've seen some selling since July the 15th. And you can see on the chart the Magnificent Seven, which are the sort of seven tech stocks: Nvidia, Google, Apple, Amazon, et cetera, Microsoft, that everybody talks about. Those are down just over 11% since the market high in July, and that's of course driven the S&P 500 down about 5%, probably a little bit more after today. And what's interesting is the sort of equal weighted index, which is that blue line at the top. If you look at what's happening in the broader market, it's only down about 1%. So you may have heard of things like the sort of the rotation trade that's happening. What's really been happening is folks have been saying, hey, these tech stocks may be a little bit overbought, a little bit high from a valuation perspective. And so what we're going to do is sort of go buy everything else. And so the average stock in the S&P 500 has not done all that poorly over the last month or so. It's really been driven by sort of a sell-off in technology. At the same time, we've seen rates go down sort of really significantly over the past, not so much in July, but really significantly over the past 4 or 5 days last week when sort of some of the unemployment data came out and sort of sparked fears that we're either in a recession or we're quickly headed for a recession. And so I wanted to take a few minutes to unpack what's going on sort of in the interest rate bond side of the world. But what's most important about this entire thing is when you put all of this together, the results are not nearly as bad as you probably think. So you can see in this third chart, you see the S&P 500, it's down 5%. Since July, but bonds, because interest rates are down, that means bond prices go up. They move inversely. So bond prices are up 2.6%. That's the green line at the top. And so your 60/40 portfolio is down 2%. That's not all that bad, and I think if you turn on the news, probably what you're gonna be sort of tempted to believe is that things are a lot worse than they really are. So we're down a little bit over the last few weeks, but things for balanced portfolio investors, and most of our clients have some combination of stocks and bonds. For balanced portfolio investors, probably down a little bit, but not down all that much. And when we zoom out a little bit, like I kind of talked about at the beginning, when we zoom out and to have a longer term perspective, right? That 60/40 balanced portfolio is still up 9.14%. So up over 9% for the year. That's not bad. If we had told ourselves back in January that by August we'd be up 9% with some of the year left to go, we would be okay. Most of our financial plans and our investment policy statements, it sort of look for returns in the 7-8% range, right? So if we're getting 9% and we're in August, we're in great shape. You can see the stock market up. By the way, for the year, still 13%. Again, when we zoom out and we take a longer term perspective, yeah, we've come off the high a little bit, but we're still, from a year to date perspective, still in a really great place. And if you think about it, if you're really happy about where the market was and where your portfolio was in June, if you just sort of go back across this page and you look, we're really back to where we were, in the middle of June. We're really not all that far from where we were in the middle of June. So when we go through periods of volatility, it's really important just to keep a long-term perspective. We could have some more selling from here, but even if we have a little bit more selling from here, we're still going to be pretty positive from a return perspective so far for 2024. So keep a long-term perspective regardless of what you hear in the news. Let's dive in a little bit to what has caused some of the selling. I know that's what is keeping a lot of us up at night. Are we going to have a recession? Are we in a recession? Those kinds of things. So let's dive into the data a little bit. And I think it makes probably the most sense. There were a couple of things last week that kind of sparked all of the selling. So I think we'll start with the ISM data and touch on that a little bit, and then we'll go talk a little bit about unemployment. So last week we got the ISM manufacturing and services surveys. The ISM and sort of manufacturing and services indexes measure activity at businesses, and they're intended to sort of try to measure increases or decreases in activity ahead of time so that we can use that for forecasting. And these are surveys, they're indexes, and so anything above a 50 means that the economy is growing, or that the activity within that sector of the economy, so either services or manufacturing, is growing. Anything below 50 means that it's declining. So what we saw last week is that the manufacturing PMI is down to around 46.8. That's pretty low, but we've been in the low 40s before this year, and certainly we've seen pretty sluggish manufacturing activity so far this cycle. The services PMI came out today, and it was up above 50, and so we see still expansion in services. That's kind of what's holding on the economy, and you can see on the chart both of those numbers, the activity in the service sector and the activity in the manufacturing sector, has been declining over the past year. So that's not really new. The decline has continued. It hasn't really changed. We've been going down. Are we anywhere close to the levels that you see for, recessions that we saw in 2020, or, go back, you can go back to in the manufacturing index, back to the stock bubble that burst in 2021, or in the great financial crisis in 08, 09. No, we're nowhere near those levels, right? But we certainly have seen a decline in activity after the big spike in activity that we saw post-COVID. So we're coming down off the sugar high. Economic activity is slowing. Business activity is slowing. It's not in a great place, but it's also not in a terrible place where we sit today. Let's talk a little bit about unemployment. That was kind of what I think in a lot of ways sort of kicked off this whole thing last week. We got sort of weak data on Thursday morning with unemployment claims, UI data, and then again on Friday we got the non-farm payroll report. So the non-farm payroll report on Friday showed job gains, right? Positive, not job losses, net job gains of 114,000. And that's below what we've seen the past few years as we've been recovering from COVID. We've seen lots of non-farm payroll reports and job creation that's been plus 200,000 every single month. That report also showed the unemployment rate rising to 4.3%. In conjunction with that rise, you may have heard about this thing called the SOM rule. That's been in the news a lot. Claudia Sahm is an economist, and her work suggests that anytime the 3-month moving average of the unemployment rate rises more than 5%, we're in a recession. And that was triggered with the unemployment report that came out on Friday. And it's been historically a pretty good indicator of recessions. That's certainly spooked the market. So we have a weakening labor market. There's no question about that. That, by the way, was true 6 months ago. It was true in our last outlook that we did for the third quarter. That hasn't really changed. But before we all run for the hills, 3 weeks ago, markets were very much in the sort of soft landing, no recession camp. And we've seen weaker data lately, but none of that data is as sort of, I think, as bad as the news cycle would suggest at the moment. In the past, when the SOM rule has been triggered, the economy was either losing jobs, so non-farm payrolls were negative, or they turn negative within a couple of months after the SOM rule was triggered. So we'll be watching for that over the next couple of months. But we're still positive, and we had a hurricane last month. I think there may be some sort of, like all the economic data, so maybe some puts and takes in the data that mean that, our activity is really closer to 150 or 160,000 sort of jobs that we're creating every single month. And when we look at the next chart, we can sort of say, hey, what does normal look like when we're in a non-fiscal stimulus, non-sugar high post-COVID job growth? What does normal job growth look like for our economy? And the average in the 2010s was 185,000 per month, not north of 200,000. The current 3-month moving average for new jobs for non-farm payrolls is 169,000, even including the sort of weaker report that we had last week. So you can see some volatility in the data. Perhaps we're on sort of the weaker side of the historical averages, but we're still a long way from mass layoffs, net job losses, the kinds of things that we really need to happen for a significant recession to occur. Secondly, a lot of the rise in the unemployment rate has been caused by new entrants to the labor force over the last couple of years. That's new this cycle. It hasn't really happened in past cycles. Some of that's definitely due to immigration. It's probably not due to the illegal immigration that you're immediately sort of thinking of, because I think most of those folks don't pick up the phone when the federal government calls and says, "Hi, I'm from the government. I'd like to help you. Will you answer my survey?" Right? They hang up the phone and don't ever pick it up again. So I don't know that it's so much illegal immigration. I think some of it is just due to immigration in general, and a lot of it's also due just to the wind down of stimulus programs and folks that need to rejoin the labor force because prices are up and their job as an Instagram influencer hasn't been working out all that well, and so and folks needing to rejoin the labor force is maybe an indicator of some weakness. So there's kind of some puts and takes there. But in the past, we have not seen the unemployment rate rising this much trigger the Stamm rule because of additions to the labor force. It's always been because we're in the midst of job losses, cuts, things like that. And so we're seeing something different this time. So I'm not sure that just because we hit this sort of theoretical trigger in the Stamm rule, that means that we're in a recession and we all need to sort of run for the hills. I do think the labor market is continuing to weaken, but again, the key is to look for layoffs to go above normal. We have not seen that, and what we're really seeing is companies just slowing down their hiring. They're still very reticent to actually cut workers because everybody, if you're still working, and you sort of know this intuitively, but you worked really hard to staff everything up coming out of COVID, and so I think most companies are still in the mix of saying, hey, maybe we're not going to hire quite as many folks this year, but we're certainly not going to lay people off because we know how hard it was to get fully staffed. So the unemployment picture, again, it's weakening. It's been weakening for the last 6, 8, 12 months. That's not new. Some of that was good. That's what we needed to drive inflation down. But I'm not sure that it's so bad that we all need to run for cover either. The other big driver of returns over the past week was earnings reports from the tech companies. A lot of the Mag 7, the Magnificent Seven tech stocks reported earnings last week, and most of them missed expectations, but they still grew their businesses pretty substantially over the last 12 months. So I thought I would talk about that a little bit because I thought it's just interesting to put this in perspective, because we see the earnings report come out and then the stock goes down 5%. You go, man, that must have been really bad, right? Apple grew revenue by 5%. Operating income was up 10%. Microsoft sales were up 12%. Operating income grew 15%. Microsoft grew their cloud computing businesses. Microsoft grew their cloud computing business, Azure, which is largely the AI piece of what's happening at Microsoft. They grew that business by 30% year over year. Pretty good. Analysts were hoping for 31%, so that's why the sell-off was there. Amazon grew revenue by 10% and nearly doubled operating income up to 91%. Google grew revenue by 15%, operating income by 25%. It's probably the sole company to sort of beat estimates on cloud growth. So I use all those examples to illustrate two things. First, this is not 1999. Are some of these companies overvalued? Probably, right? We've seen really strong returns in this sort of group of stocks over the last year. I would not expect it, at all for that to just sort of just continue into perpetuity. That never happens, right? It's never happened in history. It's not going to happen now. But are they unhealthy, not growing, not producing profits like we saw with a lot of stocks in the tech burst in the 2000s? No, they're far from that, right? They produce tremendous amounts of earnings, profitability, cash flow, et cetera, every single quarter. The second point is, if the economy continues to slow down and consumer spending weakens, the job market continues to struggle. And if we get past, now we're probably in the sort of soft landing place where we can sort of sit here for a while and not have a recession. But if we continue to go that direction and we have job losses, these are the companies that are still going to grow their earnings because people aren't going to stop moving things to the cloud. They're not going to stop AI development, those kinds of things. Traditionally, in economic downturns, investors flock to staple stocks, right? So your consumer packaged goods, other things that you buy at the grocery store. And so far for the second quarter, those consumer staple companies are only growing revenue by 2% and earnings by 1%. So that's not really a recipe for success. You probably heard last week, PepsiCo, right? Not great earnings report. McDonald's, declined for the first time in years. And so we're not seeing great results from the companies that sort of have in the past maybe been sort of safe havens. So it's important to really pay attention to what's going on in earnings and not just sort of prior rules of thumb. Overall, earnings growth has been pretty strong. We surpassed analyst expectations as of Friday. FactSet showing the S&P 500 growing earnings for the quarter at 11.5%. That's not bad. That's also not what we see in recessions, right? We don't see positive earnings growth, certainly not double-digit positive earnings growth. So I think when we think about the unemployment picture and we think about the earnings picture, putting it a little in context a little bit, I think is really helpful. And I think it helps kind of remove some of that immediacy that we feel from, man, returns are down, the stock market's down, what's going on. I think things are not as bad underneath the covers as they might seem based on the news cycle. The other thing that's been in the news a lot certainly over the weekend and then over the last couple of days, is the rumor that the Fed's going to cut before their scheduled meeting. or that they'll cut rates by a percentage point. Jeremy Siegel, I think, was in the news today saying, hey, they should do 275-point cuts. I think it's kind of funny. Most of these folks 3 weeks ago were in the soft landing camp, and now they want sort of the Fed to intervene in some sort of emergency that we're having. This is not an emergency, and I think cooler heads probably will prevail. The Fed has only cut unexpectedly between meetings twice in my career: 2008 during the Lehman crisis, and 2012 or 2020, sorry, during COVID. In both of those cases, markets were having trouble functioning because of the severity of what was going on at the time. We were in the middle of the global financial crisis. We shut down the economy for COVID. There were issues simply executing trades and things like that. This is neither of those scenarios. There's also some risk that in unexpected cuts, if the Fed comes out and say, "Hey, things are worse off than we thought," right? There's fear that they could spook the market, right, and that causes more panic selling. So again, I think cooler heads will probably prevail. You can see the chart on inflation that we just pulled up. Inflation has come down, right? We're pretty close to spitting distance from the Fed's 2% target. We've been talking about this for a while, but I think we're going to be very close to, if not at 2% by the end of the year. So it is time for the Fed to cut rates, right? But they can probably wait till their meeting in September, and I think all will be fine. We didn't get worked up when the market expected 6 rate cuts this past January. That was crazy at the time. We didn't get worked up when we went down to no rate cuts and stagflation in March, and we shouldn't, sort of change our views now that the market's back to 6 rate cuts again in August. The point for all of us as investors is to sort of to keep a steady, hand at the helm, if you will, and make rational decisions, even when the market becomes a little bit irrational. Some of that trading over the last few days probably has been exacerbated by hedge funds and other types of investors that have to sell when big drawdowns occur unexpectedly. So selling begets more selling, and that probably drove the sell-off, particularly today, Monday, more than anything else. There may be more of that to unwind, but I think we're pretty close to the end of that based on the activity that I've seen in the market over the last couple of days. So in conclusion, I think we're experiencing a correction. The economy is slowing down. That's been the case for more than a year. That's still the case today. This is not things are all rosy and everything is good. I don't think that's the case either. We're definitely slowing down. We're in a very slow growth environment. That's what happens when you raise interest rates to 5.5%. But I don't think there's any reason to panic. I think the best thing that we can do is have a long-term perspective and keep in mind that the stock market is up 13% or so far this year. And I think the more we zoom out, keep a longer term perspective, I think the easier it is for us to make rational long-term investment decisions. I've spoken to several folks over the past few days. If you have questions or concerns, I'm happy to talk one-on-one. Shoot me a note, give me a call. We can talk further. Enjoy the end of your summer, and hopefully the market will turn around a little bit, and I will talk to you soon.